In February of 2026, average mortgage rates dropped to 5.98%, making everyone think the housing market was finally cooling off. But by mid-July, that average 30-year fixed rate shot right back up to 6.55%. According to Freddie Mac data, that little jump does not just look annoying on a chart. It can easily cost you tens of thousands of extra dollars over the life of your loan. Buyers are getting dizzy from this financial whiplash. Hey friends, X-Money Lab here. Today, we are diving into this unpredictable real estate roller coaster to find out exactly what is causing these wild rate swings. So, who or what is really pulling the strings behind the scenes, and how can you protect your wallet? Let us find out. 1. Who actually sets rates? If you are blaming the Federal Reserve for your expensive home loan, you are barking up the completely wrong tree. Here is a massive secret. The Fed does not actually set 30-year mortgage rates. That is right. They control short-term borrowing costs. But your long-term home loan? That is secretly chained to something completely different. The 10-year Treasury yield. Think of the 10-year Treasury as Wall Street's ultimate safety blanket. When global chaos erupts or the economy looks shaky, investors pour money into these government bonds. Mortgage lenders look at these Treasury yields to figure out how much risk they are taking. If the yield on a 10-year bond goes up, lenders immediately hike up 30-year mortgage rates to compensate. This means your home buying power is at the absolute mercy of daily stock market panics, not just scheduled government meetings. For example, the Federal Reserve held its benchmark interest rate absolutely steady at 3.75% during its June 2026 meeting. They did literally nothing. But because United States inflation hit 3.5% that same month, staying stubbornly higher than the Fed's 2% target, bond investors completely freaked out. That inflation panic sent Treasury yields rocketing higher. And just like a miserable game of follow the leader, mortgage rates spiked on the exact same day, crushing buyers' budgets. Right now, almost 82% of interest rate traders expect the Fed to keep rates totally unchanged at their late July 2026 meeting due to this persistent inflation. So even if the folks in Washington take a vacation and touch absolutely nothing, a single bad economic report or global panic can make your dream house vastly more expensive by tomorrow morning. 2. The 2026 inflation problem. So, if stock market panics are jacking up your mortgage, what exactly is causing Wall Street to lose its collective mind? The villain of this story is a stubborn monster that refuses to die. Persistent inflation. You see, a few months ago, buyers got a massive tease. The market thought this beast was finally defeated, and lenders briefly slashed borrowing costs. People were rushing to open houses like it was Black Friday. But that celebration was completely premature. The economy stayed surprisingly hot. Prices for everyday goods refused to drop, and that inflation monster roared right back to life. This terrified bond investors, who immediately slammed the brakes on cheap money. Because of this relentless pressure, experts are throwing their optimistic predictions right out the window. A recent June 2026 Reuters poll of real estate experts confirmed a harsh reality. Mortgage rates are not expected to fall meaningfully anytime soon. In fact, Fannie Mae's latest housing forecast predicts 30-year fixed rates will remain hovering around 6.4% through the entire rest of the year. The dream of a sudden drop back to pandemic-era pricing is officially dead and buried. What does this financial whiplash actually mean for your wallet? Let us break down the math. On a standard $300,000 mortgage, locking in at a 6.5% interest rate means your monthly principal and interest payment sits at about $1,896, according to Freddie Mac. If borrowing costs had stayed down where they briefly dipped earlier this year, you would be saving hundreds of dollars every single month. Instead, this stubborn inflation penalty is eating directly into your family budget, forcing you to buy less house for way more money. Lenders are absolutely terrified that the cash they lend you today will be worth less tomorrow because of rising prices. To protect their own profits, they bake that fear directly into your home loan. As long as prices at the grocery store and the gas pump stay elevated, mortgage rates will continue this unpredictable, chaotic roller coaster. You are essentially paying the price for an overheated economy every single time you sign a closing document. 3. The cost for buyers. That dream house you fell in love with at Sunday's open house? By Wednesday afternoon, it could be completely out of your price range, and the seller did not even change the listing price. Welcome to the brutal reality of volatile mortgage rates, where your purchasing power can evaporate literally overnight. When borrowing costs swing wildly from week to week, it creates a brutal financial whiplash that destroys your ability to plan, save, or even know what you can actually afford to buy. Let us really dig into the raw math of what this daily chaos actually means for your wallet. Earlier, we mentioned that a standard $300,000 mortgage at 6.5% sets you back about $1,896 a month in principal and interest. But consider what happens when the market sneezes and rates jump just half a percentage point, pushing you up to 7%. Suddenly, that exact same house, with the exact same loan amount, costs you nearly $2,000 every single month. That tiny, seemingly harmless 0.5% hike just stole over $100 straight out of your monthly family budget. And over the lifespan of a 30-year loan, you are handing the bank an extra $37,000 in pure interest. That is a brand new car, completely vaporized, just because you closed on the wrong day of the week. But the pain does not stop at higher monthly bills. This volatility acts like a stealth tax on your overall borrowing limit. Let us say you sat down at the kitchen table and rigidly capped your housing budget at exactly $1,900 a month. When interest rates are sitting pretty at 6%, the bank says, "Congratulations, you qualify to borrow about $317,000. You start browsing nice 3-bedroom properties in a decent school district. But then, a spooky inflation report drops. Bond investors panic, rates spike to 6.5%, and your phone rings. It is your lender. Because the cost of borrowing just went up, your firm $1,900 budget can now only buy you a $300,000 loan. In the blink of an eye, $17,000 of your purchasing power just vanished into thin air. You did nothing wrong, your salary did not change, and your credit score is still flawless. Yet, you are suddenly forced to look at completely different neighborhoods. You are suddenly looking at cramped 2-bedroom houses instead of spacious 3-bedroom homes, or properties that desperately need a brand new roof and a massively expensive kitchen remodel. You are quite literally paying vastly more money to buy significantly less house, all because Wall Street bond traders got nervous about grocery prices. This is exactly why the housing market feels completely frozen right now. It is virtually impossible to budget for the biggest purchase of your life when the target is constantly moving. Imagine trying to hit a bullseye while riding a roller coaster blindfolded. That is what house hunting feels like today. Buyers are getting pre-approved on Monday, making an eager offer on Wednesday, and finding out by Friday that a sudden rate spike means they absolutely no longer qualify for the exact loan they just signed a contract for. It is emotionally exhausting, incredibly frustrating, and financially terrifying. This unpredictability creates a massive psychological wall. Buyers are terrified to pull the trigger because they are scared rates might drop next month, leaving them trapped in an overpriced loan. Meanwhile, they are equally terrified that if they wait, rates might skyrocket even further, pricing them out of the market entirely. This chaotic environment forces families to sit on the sidelines, clutching their down payment savings, completely paralyzed by indecision. Until this rate volatility finally settles down into a predictable rhythm, millions of hopeful buyers are trapped playing a high-stakes guessing game where the rules change every single morning. 4. Should you buy or wait? So here is the massive, life-altering question that is keeping you awake at night. Do you grit your teeth and buy a house right now, or do you stubbornly sit on the sidelines and pray for a market miracle? Let us rip the band-aid off immediately. If your entire strategy is holding out for mortgage rates to magically plummet back down to 3%, you are going to be waiting until pigs fly. That era of virtually free money was a historical anomaly, and it is firmly in the rearview mirror. Look at the hard numbers. The Federal Reserve held its benchmark interest rate steady at 3.75% during its June 2026 meeting. They are refusing to cut rates because United States inflation hit 3.5% in June. That is still stubbornly higher than the Federal Reserve's rigid 2% target. In fact, almost 82% of interest rate traders completely expect the Federal Reserve to keep those rates totally unchanged at their late July meeting. Wall Street has spoken, and the mid-6% range is simply the new normal for the foreseeable future. So, When should you absolutely walk away and wait? You need to hit the pause button right now if making that current monthly payment would stretch your family budget so thin that you are surviving on instant noodles just to keep the lights on. If you are already financially strained, do not let the fear of missing out push you into a devastating 30-year mistake. Renting for another year while you build up your savings is a vastly smarter financial move than drowning in a mortgage you simply cannot afford. There is zero shame in stepping back when the math does not work for your specific wallet. But what if the math actually does work for you? If you have a stable income, a solid down payment, and you find a property in a neighborhood you genuinely love, then yes, you should seriously consider buying right now. The golden rule in today's chaotic market is incredibly simple. If you can comfortably afford the monthly payment today, and you plan to live in that specific home for at least 5 to 7 years, you need to stop obsessing over the daily rate charts. Time in the market almost always beats trying to time the market. Think about the long game. If you buy your house today and rates eventually do drop a few years from now, you can simply refinance your loan to secure that cheaper monthly payment. You are essentially marrying the house but only dating the interest rate. However, if you choose to wait on the sidelines for cheaper borrowing costs, you face a massive risk. While you are waiting, overall home prices could easily continue to climb. You might eventually get a lower interest rate, but you will end up applying it to a vastly more expensive house, completely wiping out your supposed savings. Do not let the daily economic rollercoaster paralyze your life plans. Base the biggest purchase of your life entirely on your personal, immediate budget, rather than stressing over what nervous bond investors are panicking about this week. You control your financial destiny, not the Federal Reserve. If this deep dive helped untangle the current real estate mess for you, make sure to smash that like button and subscribe to X Money Lab for more no-nonsense financial truth. Let me know down in the comments if you are bravely house hunting right now, or playing it safe. Keep your money smart, and I will catch you in the next one.